The most traded currency pair in the world is one most beginners encounter on their very first day, the euro against the US dollar, written as EURUSD. Understanding how it works is not optional for a forex trader. It is foundational. Here is what the price actually tells you. If EURUSD is trading at 1.08 December, 1 euro costs $1.08. When that number rises, the euro is getting stronger against the dollar. When it falls, the dollar is gaining ground. That relationship drives trillions of dollars in volume every single trading day. Every currency pair has two parts. The first currency listed is called the base currency, in this case, the euro. The second is the quote currency, the dollar. The price tells you how much of the quote currency you need to buy 1 unit of the base. When you buy EURUSD, you are buying euros and selling dollars at the same time. When you sell, you flip that. You are always making a judgment about two economies at once, not just one. That is what makes Forex both interesting and genuinely difficult. So why does this particular pair attract so much attention? Two reasons stand out. First, the Eurozone and the United States are the two largest economic regions on Earth. The volume of trade and investment between them is enormous, which means the market for this pair is very deep. Second, that depth creates tight spreads, the gap between the buy price and the sell price. Tighter spreads mean lower costs, which matters whether you are just starting out or trading every day. Several forces move EUSD. On the US side, watch employment data, inflation figures, and Federal Reserve interest rate decisions. Strong US data tends to push the dollar higher, which pulls EURUSD down. On the European side, the European Central Bank sets the tone, along with economic data from Germany, France, and other major Eurozone economies. Political uncertainty in Europe can also move the pair sharply. When the Fed and the ECB are moving interest rates in different directions, capital flows toward the higher-yielding currency, and that is often where the bigger trends come from. For timing, EURUSD is most active during the overlap between the London and New York sessions, roughly 8 in the morning to noon Eastern Time. Spreads tighten, volume picks up, and price moves more decisively. Outside those hours, the market can slow down considerably. Trading involves real risk. Most retail traders lose money, and leverage amplifies losses just as quickly as it amplifies gains. Only trade what you can genuinely afford to lose. The practical takeaway: before putting real capital on EURUSD, spend time watching it during that London-New York overlap. Observe how it reacts to US data releases. Pattern recognition built from observation is more valuable than any shortcut.